Dell Computers is down approximately 35% this year. And there are some value investors that are saying that this stock is incredibly cheap and is trading at approximately 5 times next year's earnings. But in this video, I'm going to show you why that's a mistake, because the company is trading at a much higher forward earnings valuation because the earnings is not expected to be that high. But before I get into that, let me run the intro. What's up, guys, and welcome back to the channel. Now, this is what I'm talking about. You can see that Dell is down approximately 35% year to date. So the first question that I have is, what exactly is causing the share price to decline that much? And the reason why I asked that is because I follow the global PCS market and noticed that in a press release that was put out in June of last year, they did say, the Personal Computers Global Market Report did say that the market of personal PCs is expected to reach $224.3 billion by 2025, which is a CAGR of 8.5%. And so that seems to be a very strong forecast for the market as a whole. So why is it that computer makers' share prices like Dell and HP have dropped so much thus far in 2022? Well, you can see here that the share prices are declining because these computer makers are warning of weakening consumer demand in the short term. So noted that they said that in Q2 they executed well and they delivered strong financial results. However, those strong results are in spite of a rapidly changing and challenging macroeconomic environment. And in the second half of this year, they expect macroeconomic conditions to become even more challenging as consumers are taking a more cautious view of their needs given the uncertainty in this environment. And this is not dissimilar to HP. So you can see this Wall Street Journal article where they said that although they see long-term PC demand remaining above pre-pandemic levels, they are warning of a slower business spending environment in the short term. So specifically, HP said that sales declined in the last quarter and the PC maker cut their outlook as it joined a growing list of companies to report a slowdown in consumer spending on electronics. And they even cautioned about weakening economics going forward. Their chief executive said that worsening consumer demand is expected to continue and that the company is seeing their business appetite softening in the current quarter. So effectively what they're saying is that corporate buyers are continuing to agree to deals, but they're slowing down the translation between those deals into orders. So ultimately, it's just overall weakening in this environment, which is what we've been seeing all year. Now, I do want to go into my valuation, but before I do that, I gotta remind you guys that approximately 80% of the viewers of this channel are not subscribed. So guys, in order to continue seeing this great content on your feed, please consider subscribing to this channel. Now, what I want to do for you guys is I want to show you the way that I do a quick and dirty analysis of a company, and then I'll parlay that into my model type of valuation for a company. So you can see this is a screenshot that I took from Seeking Alpha, which is just a website that you guys all can get access to. And notice that the consensus EPS estimates from analysts for fiscal year 2023 and fiscal year 2024 approximate around $7 per share. So 7 divided by that 37.29, which is the share price for Dell, gives you an approximate 19% earnings yield, or a forward PE of approximately 5.5 times earnings. So that looks very cheap. Now, note that you can't just look at that. You got to also look at the debt on the balance sheet. So notice that they have approximately $21 billion in net debt, or approximately $29 per share. So the back of the envelope valuation is approximately $80 per share. And the way that I did that is I just took $7 per share of earnings, applied a 15 times multiple to it, subtracted the $29 per share. And so I'm getting at approximately $80 a share. Compare that to the current share price. It looks pretty compelling in terms of an opportunity. So of course, based on that, I'm gonna build a model on this to get a better understanding of what this opportunity looks like. But that's just an example of the back of the envelope, quick 5-minute valuation that I do before I decide to build a full model on this company, because building full models takes time. So you don't want to just blindly build full models on companies until you can get a bit of a back of the envelope understanding of whether it's an opportunity to even follow. And just note, guys, that just quickly, what are they doing with all the cash flow that they're generating? Well, they're quickly paying down debt and buying back shares aggressively. It also looks like they instituted a small dividend, but largely all of that free cash flow is going back to making the company stronger. So strengthening that balance sheet and buying back shares. Now, this is my model on Dell computers, and I'm actually going to break apart the thesis that many investors have where they believe that the EPS is going to be approximately $7 per share. So I'm reducing revenues in fiscal year 2023 to around 5% revenue decline. 2024, there's no increase in revenue, and then I'm slowly growing it at 3% thereafter. I think that's pretty reasonable, but notice that I'm growing it at a medium-term growth rate that is significantly lower than what the consumer market reports are suggesting. And so there is some upside to my valuation here. And notice here that my operating profit margins of approximately 5% or 4.6% is the same for the fiscal year actuals and the 2023 forecast. The difference, however, is that I'm not forecasting a gain on sale of business segments. So that $3 billion that they reported in 2022, obviously you can't predict that to happen again in 2023. And so what that's causing is my net income to decline to $2.3 million or $3 per share, as opposed to if you just forecasted that blindly out into 2023, you would get to an EPS of $7 per share. So I'm not certain that that's exactly what the analysts are doing to get to that $7 per share valuation. But what I'm saying is I'm not really sure what they're doing to get to that $7 per share valuation, because there doesn't seem to be the firepower in the operating business to suggest that you're going to get to an EPS of $7 per share for this coming year. Now, if you guys know what I'm missing here, let me know in the comments. But till then, I'm forecasting next year's earnings per share to be at approximately $3 per share. So what does that mean for my valuation? So obviously the medium term and terminal valuation is approximately $65 per share. Their excess cash or the debt on the balance sheet is around $23 per share. So a little bit lower than the back of the envelope 29 that I originally predicted. So I'm getting an EPS valuation of approximately $42 per share. Compare that to their current share price of $39 per share. And I believe that this company's trading at approximately that intrinsic value level. But note that the balance sheet is not clean, but they are cleaning it up, as I showed you when I showed you the cash flow statement. And so the important thing is, in order to get a real handle on Dell, you got to understand what that model looks like. And I made that model available to all the Patreons. And so in order to get access to that model, you can access it at the lower tier of the Patreons, which is just that lower tier $5 a month level. And if you want to join us for an epic live presentation every month, you can join us at that upper tier for the Patreons. Now, guys, I do have to say that I did do a video on their competitor HP. And so in order to understand the story behind HP, which I actually think is a better buy if you want computer maker exposure, you can get access to that video right here.